I think, in my mind, it's about the payroll number. It's really about the labor data. Period. That's what's going to dictate what the Fed does. They've said that, and that's what the market's going to trade off of. I mean, if you go back a month ago, that's when we had this correction, and it really did kick off with a weaker non-farm payroll number. Now that has been somewhat refuted by better claims, and also just the deal that jobs are okay still, but then we got the revision. So the data is still very mixed in my view. And the market under the surface, as we like to look at it, is still trading very defensively. It doesn't know. So I think it comes down to that payroll number. The Fed will react, and we'll see. And we'll see how the market goes. I mean, my general view is if they cut 25, that's probably fine. If they cut 50, historically, that has been a bad signal for the equity markets.
Mike, you say the market's traded pretty defensively. I want to pick up on that and just build on it a little bit. In some places, we've started to see that breadth improve again. Small caps have started to perform. We've seen the record highs on the equal weight through this week so far. Mike, do you think we're just as vulnerable as we were at the start of the month to weak data, or have we reset things differently this time around?
I think we're more vulnerable to another negative data point on the labor market. That was sort of a warning sign. And once again, we don't know the result, but if we get a negative payroll number, I think the market could react just as bad at the index level. So let's talk about that under the surface. I mean, you mentioned small caps have done better. Well, they did better in July when the money rotated away from the Magnificent Seven and some of the quality growth leaders, and it went into defensives, quite frankly. So defensives have now, and when I say defensives, I mean utilities, healthcare, staples, and real estate. Those four sectors have led on a 5-day basis, on a 1-month basis, and a 3-month basis. So it's been very consistent. And that's about the time we pivoted back in May to a more defensive book. And I don't really see any reason to kind of deviate from that. Now, if we get a very strong payroll number, then that trade is going to reverse sharply back to the more cyclical parts of the market. I think it's going to be very messy. I don't anticipate the labor data to improve dramatically. I don't know if it's going to deteriorate further. But given the signal from the stock market and the bond market, quite frankly, the markets are definitely paying attention to this, and this is a big number.